All right, welcome everybody to Live Valuation. I'm Midas and today we're going to be taking a look at ticker FL, Foot Locker. Been a little bit of wait on this one. I've been kind of talking about maybe covering it for several months now, pretty much ever since it had its 10K release and dropped pretty significantly all in one day. And so there was kind of like a lot of talk about it, and people would have been, smarter for, trying to get new viewers and whatnot to maybe have done that one at that point. But there's so many companies to value all the time. But I was interested in covering it, especially considering I have companies in my portfolio that are somewhat of competitors to it. So I was kind of curious to see where it was. Hey Nukip, thanks for joining in the chat. Just a fair warning, I don't really know how audible it is, but I do have downstairs neighbors that have kind of some construction going on, so if anybody hears some weird noises in the background, that's what it is. I honestly have no idea how audible it may or may not be. Hopefully it's not at all. So anyway, so before we get into that, we will take a look at the watch list, as we kind of typically do. Not too much major movements in the overall structuring of the list compared to the last stream. I already kind of talked about it. I'm pretty happy with the Smith & Wesson position. It's very, very small. Going to be building that one up pretty quickly. And I didn't buy anything else this week because, well, when I start a new position, usually I put a little bit more money into that one to kind of get it going. So, yeah, it's just the way it is. I hope you don't cave in or something. Yeah, for real. Can you hear it? I'm kind of curious. It's loud on my end, but I do have I don't know, certain filters on the streaming software. I don't know how strong it's going to be. Plus, the filters kind of level off when I'm talking. So, if I wasn't talking, okay, maybe not. Cool. That's good. That's good. Oh, it frustrates me, but it is what it is. I think the previous tenants downstairs probably wrecked the place a little bit. So, I think they have to do some reconstruction a little bit. What's going on? But anyway, getting on with that. So, like I said, we are doing Foot Locker today. I had said in the last stream that I had kind of tossed around ideas of which companies I was going to do next. I am thinking I'm going to do Inter4 next. I kind of already started working a little bit on that valuation, and I am pretty interested in perhaps covering GraphTech in the near future as well. Inter4 is a lumber operator, and so considering lumber has dropped pretty considerably down from its peaks, I'm very curious to take a look at that one. I have owned it in the past. I held it for a very short period of time and took profits relatively quickly. But the point is, I was kind of curious to see if maybe its valuation has shifted around after I kind of reconfigure the correlations of revenue with lumber and whatnot. And then GraphTech was kind of an interesting company that also had some potential, but that one's actually a little bit higher up on the list as is. So that's one of the reasons why I was like, yeah, maybe I should double check on that one and confirm that one, because both of those had valuations that were getting a little bit dated. And so I was basically like, okay, you need to either redo these valuations whenever you can, or ditch them from the list at some point, which sort of the same thing with Foot Locker. And that's kind of how I approach it. Yeah, it's a very, very interesting company. I did value it once before and I passed it up, but like I said, yeah, I'm curious to take a look at it again. Inter4, I know from Magic Formula. Yeah, I think that might have been where I found them previously, because I love that list as well. So but yeah, and then I had also said Kroger. That one also needs to be either updated or ditched. I haven't fully decided on that one. I might end up ditching that one because these 10Ks are going to be coming out in the near future. Alibaba, Microsoft, and Sandfire. So those ones will take some pretty high priority when the 10Ks come out. So it's really just kind of filling time until we get to the end of the month and those ones kind of start coming out. But anyway, so we'll get into Foot Locker. I actually will start a little bit with their earnings deck from the first quarter, kind of covering just a few of my thoughts from a few pieces in here, because I thought they had some interesting disaggregation of certain pieces in it. On the first quarter, they talk about how they have negative 2% or so in comparable sales. That's just on the quarter. They're guiding for a pretty significant mid-single digits kind of decline in revenue over the fiscal year. And my evaluation, I'm going to be a little bit more pessimistic than that, though I think, not being very pessimistic as far as how that hits their margins. So I think that kind of balances it out overall. They definitely had some downward movements in some of their categories, while upward movements in others, like they say here, increase in the apparel and accessories, but downward movement in shoes overall. Further down in this, they also had this kind of little chart where they kind of disaggregate the different sections, footwear and apparel, as well as overall, segmented by men's and women's and kids, kind of giving more specific information about which subcategories are up and down. I'm not really doing a super disaggregated model of revenue for them. We're really just kind of keeping a pretty top-down level since they're in such steady state. I don't really feel the need to kind of approach from that. But another more important way to think about it is also the geographic disaggregation. The decline coming from North America, which makes sense considering it was such a huge boom last year, while EMEA was definitely the laggard last year, and so now they're starting to kind of come out of the more pandemic shutdown that North America had come out of a lot faster. And Asia's kind of a little bit of both, I'd say, because obviously they went back into lockdowns as far as China specifically, so it's a little bit of a mixture there. And then they talk about their gross margins and expenses here, but we'll take a look at the finances when we kind of look through the numbers as we usually do. But their financial outlook here, we definitely wanted to take a look at that before moving on to the actual financials. As I said, their sales change, they're expecting upper end of down 4% to 6%. So upper end, does that mean 6% or 4%? Because the -4 is technically higher than -6, but they say upper, and I'm not sure exactly what they mean. But 4 to 6%, -4 to 6% is what they're seeing for sales change. Comparable sales being more like -8 to 10%. That's off the back of some square footage decrease, as well as the gross margin being kind of held there. Yeah, right. A little weird wording. But whatever, -4 to 6% is what they're guiding for. Like I said, I'm going to be a little bit more pessimistic than that just to be conservative. But yeah, it is what it is. It's kind of a strange way to put it. So we can kind of move on into it. And we will kind of do our best to compare to the previous valuation. I have that up here on my other screen. I will say, actually, the valuation hasn't shifted all that much. My, well, it's shifted a little bit. It's upward. Wait, hold on. Yeah, never mind. I actually had scrolled down to the wrong number. I was like, wait a minute. I thought they were much closer than that. Yeah, my previous valuation is $28.38 is the current fair value I have for it. So now it's $28.83. It's basically hardly shifted, but that is on the back of a decent amount of shift in the fundamentals. Obviously, they've grown in revenues, and this is basically the same story I gave for a couple of my most recent valuations. It's like they've increased their fundamentals, that is their revenue base and therefore the overall profit base that they have to work with, but that's off of the back of basically everybody's costs of capital increasing this year, and therefore everybody's discount rates increasing this year, both because of interest rates and also just because of general increases in other types of risks that attribute to the overall discount rate. Like for example, the discount rate that I have over here on Foot Locker on my previous valuation is $13.93, and then my current one is $16.72. So it's almost 3% increase for the base discount rate that I'm using in this model. So even though the revenues have increased 18% year over year, that has a pretty significant effect on all that. What is their customer demographic? Well, I actually don't have like if you mean like what percentage of their customers is more like men or women and what percentage is in which age groups, I haven't really overly looked into those specific information because they're, like I said, in mostly steady state. So I wasn't trying to like think about different ways to project the revenue in overly specific form. Obviously, like I said, that's one thing I saw that they had this little chart piece that they put here, but they didn't exactly give us percentages for what groupings that they are in here. I honestly wasn't super concerned with that. Their demographics is, from my understanding, generally a little bit more tilted towards men because they're more acclimated towards like sports shoes and stuff. But obviously, they would have a mixture of it. But across all income classes, I think they're pretty middle of the pack as far as income classes go. Because, for example, the other competitors of theirs that I am invested in are hitting a little bit more of the lower income groupings. So that being Hibbett. Anyway, so we'll come down to the segmentation. As shows here, they have 78% of their sales in their direct stores, with 21 to 22% of it coming in direct to consumer. Do you know anybody that buys shoes there? Well, I mean, I've bought shoes there. I don't know. I kind of jump around as far as like where I'll get my shoes from, but I don't really buy shoes super regularly. I'm not like a big shoe person myself, but I mean, I bought shoes there, what, a year and a half ago, I think. Am I asking too many questions? No, man. I mean, keep asking questions. I just gotta keep talking in between them, sort of, depending on how it works. You seem to be the only one that's chatting in the chat today, so you know, I appreciate the company. Anyway, so like I said, 21 to 22% in direct to consumer. Pretty significant growth since the beginning of the pandemic. They were, I believe, more in the teens before the pandemic, so it's been a pretty significant increase to their website, which I actually didn't really do any exploring of. But you know, when I buy shoes, I pretty much like to always try them on myself. I'm not sure. I've never really bought much clothes or shoes online myself, so that's just a personal thing. But whatever. The unlevered beta for the segmentation between that I come to is 1.17, and sales capital 2.34, so pretty in line with what we typically see for retailers, a pretty high sales capital ratio. And net margins typically pretty low, for the industrial group being 5.74, which they're pretty in line with their industrial grouping, a little bit lower on the sales capital ratio for reasons that we'll get into when we look at the financials. But their margin is pretty in line with that, at least over the long term, not for the last 2 years. The last 2 years they've had a little bit higher of margins because of, well, you know, most companies have been profitable. Man, I don't know why I'm like sweating so much right now, but I think my air conditioning is a little bit low. Anyway, so the debt to equity ratio that they currently have is 135 to 136%, off of the back of a pretty significant increase in debt a few years ago, which is one of the things I was talking about, where the sales capital ratio is a little bit lower, but we'll cover that in the financials, basically because they increased their debt pretty significantly. But including their listed debt as well as their lease liabilities, they have 3.3 billion or 3.4 billion or so in debt, at a weighted average maturity of 7 years. And that comes at a weighted average interest rate of 4.61%. So not a terrible interest rate overall, and a pretty decent maturity profile. Oh, that was one other thing I was going to show from the presentation. That was like near the bottom, I believe. They did actually talk about a little bit of their leasing here at the bottom, the real estate flexibility and growing off-mall mix. So the average term remaining specifically for the lease liability portion of their debt is, as they can see, is moving downward over time, and that is in line with what I found in their information on their debt in the 10K. But that basically they're kind of putting that as them having flexibility to be able to move to other options, which I would argue that that's a little bit of a nice way of putting it too, because you could argue that that means that they're taking on larger capital expenditures over time, or they're going to have to renegotiate those lease terms under new interest rate environment in the future. So under one circumstance, they might have to increase their interest rate. Another circumstance, they might have to increase their overall capital base, which again, they already increased their capital base a few years ago with the increase of a large new portion of debt. So the real question is where that's going to end up exactly when this goes down. Will they actually roll it over into new leases, or will they just take those assets directly onto their balance sheet? So anyway, we will take a look at their financial history briefly. Hold on over. These guys are a bit shady. Well, I wouldn't necessarily call it shady. They're just doing the typical corporate thing. I mean, they're not lying in the numbers. They're just using the word flexibility. You know, I mean, they're not wrong that technically it gives them options, the more options. It's just they're trying to use optimistic sounding words, you know. It's their job. It's their job to make everything sound rosy, and it could be rosy. I'm pessimistic on interest rates, and I'm just pointing out that the other alternative other than interest rates is that they have to be able to take the capital base on. For all I know, taking the leases off and instead owning the stores directly could in fact be a boon to their business. Options for what? Like changing locations? Yeah. Changing locations, but also, like I said, changing their capital base. It's like you can either own the locations directly or you can be renting them. And that changes your overall profitability profile in a large way. Like if you own the properties directly, you'll have larger capital expenditures up front, but you'll probably be more profitable versus the leases. You'll have less capital expenditures up front, but you'll be less profitable because you'll be making the lease payments. That's in general. There's a lot of mix and match with that. So it's just, they're talking about how that gives them flexibility. That includes both the ability to change locations, which is what they're kind of implying here on this part of the graph, But over here, they're talking about how that gives them the option to change literally the way that they're funding their business in the first place. So, and easier to liquidate leases. Yeah, there's all sorts of differences between these facts. Oh, hey, Fuha, welcome to the live chat. Nice to see you found it onto the live stream as well. Anyway, so we will take a look at the overall financial history. You can see in 2012, they had about $6.1 to $6.2 billion in sales. They basically grew pretty consistently, single digits, pretty mid-single digits up through 2016, and then it kind of dropped relatively low for a few years following that. 2020, they had a decrease, and then obviously in 2021, we had this very, very large increase, 18 to 19%. So if we take a look at the 5-year CAGR of sales rolling over the time frame, it was still in the kind of single digits, but you can see it kind of trailing downward over time, though it recovered back to this kind of 2 to 3%. The average of all the rolling periods is 2.86%, so 2 to 3% rolling CAGR over the entire time frame. It's pretty steady state. That's basically kind of what I was saying. It's like I don't really feel the need necessarily to think too granularly about how all their finances work necessarily when projecting on revenues. I'm at my job, but good work. I'm guessing it might be a value play through stores and e-commerce. Perhaps. You may have showed up when we weren't the value that I kind of already have up here. So yeah, but I have it at a little bit undervalued, not majorly so. It's I'll explain part of the reason why. It's like in one sense it is a value play, but there's a lot of risks, so that's why my fair value doesn't really show it as actually having that much value. But the potential returns are very high. The current value is not really that high, I would say, but the future value is very high, and that comes from the risks, which we'll get into. But anyway, so you can see the gross margin. There's a pretty significant shift in the gross margin over time as well. We said that a pretty large shift in their capital structure happens around 2018, which is when they take on a large amount of their debt. You can see that's also when the gross margins shift over too. They go from this kind of low 40s, 42% as an average, down to an average of 31% over these 4 years. It has tipped up to 34% in 2021. So a huge downward move in the gross margins. I actually think that is when they took on the debt, and then that's when they basically started to do this rollover period of shifting out of leasing the properties from malls to trying to actually have more of their own properties. I do believe that is specifically the strategy. But whether or not, like I said, that actually turns itself into a profitability moving down the road is a little bit hard to say. We'll get to see. I'm going to head out, but good stream. Also gross margins. Yeah. So anyway, taking look at the net margins. If we take a look at net margins as they were averaging up through 2017, which is before the capital base change, as we were talking about, that's an average of 6.63%. And if you take a look at the average of it after that, it's 6.8%. So not really any changeover in that, but you could argue that kind of has to do with a little bit of the overall, yeah, you know, it's gross margins. I know it's a factor of the fact that I just learned to read it, but technically you're typing grass, so that's not really the same thing either. Gross, I know. It's just kind of I spend more time reading than I do talking about these things, so you know. Anyway, as I was saying, the net margin hasn't really shifted after the capital base change. So like I said, the point of changing the capital base is maybe to be able to shift into a higher profitability at the expense of higher capital expenditure. So without having that change, that kind of makes it arguable that they're not really achieving what they wanted. Although, like I said, it's not a very large period of time frame to look at. Not to mention, we do have a higher net margin in the most recent year, though that's at the same time as most retailers having higher margins, as we've discussed through many of our valuations. So we can't necessarily take the 1 year data point as an indicator that the plan is working per se. I'd like to see 3 years in a row of margins being well above 6%, maybe around 8% or something, to see that they're actually getting a significant changeover in the profitability. And like I said, the cost of where that profitability comes from, we'll get to. That's in the sales capital ratio, which is kind of down at the bottom. Anyway, looking at the cash flows before we do get into that, we can see that the free cash flow equity that they had for the first 5 years of the historic period that we had, it averaged 454 million that they could pay out to their common shareholders, and then the average amount that they did pay out to their shareholders was 394 million. So a pretty good significant amount of payout, but not overpaying the shareholders in the first 5 years. that switches over to an well, actually, I'll do the top first. That switches over to an average potential payout to shareholders for the next 5 years of 436 million, and then they did in fact pay 437 million. So, you know, just barely over the line of overpayment. But as I've discussed in other ones, when it's that close, you can kind of really just argue that it's not an overpayment as so much as a slight difference in calculation because of what I'm calculating versus what they're calculating. There's, you know, I'm including some things, not including other things. They're including one things, different things. Roughly speaking, it's about the same. So what that basically means is, yeah, they pay out pretty significant amounts of dividends and share buybacks, but they're definitely not overpaying, which is good. That's what we like to see. Hello from Italy. Hello to Italy. Thank you. Welcome to the stream. Anybody who's watching right now, if you have not already, it would be really appreciated if you could subscribe to the channel. You'll get notifications so that you can join our streams more regularly. And if you haven't already as well, it would be really appreciated if you could like the stream so we could attract more people to this content. We'd really, really appreciate it. Thank you very much, guys. Anyway, so taking a look at the returns on invested capital, pretty strong returns on invested capital. If you take a look at the overall time frame, however, you can see there's a very significant changeover in the returns on invested capital around 2017 to 2018, which is exactly what I was talking about, the shift in the capital base. They went from, for the first 5 years of the historic period that we're talking about, averaging 30% returns on invested capital to now averaging for the next 5 years of 15.88%. So what happened? They didn't lose their returns. In fact, their returns have grown since then. So what happened is they increased their capital base significantly. And that's exactly what I was saying that they did. They increased their capital base, but they didn't really increase their returns enough to counteract that. And so the returns on invested capital have dropped pretty significantly. So the last 3 years on average, it's averaged about 11%. That's kind of the base I'm going to use because, well, let's face it, that's what's happened. So what you could say is that when they had these high returns on invested capital before that, they were still just kind of riding high on the investment that they had made in the past, but they were long past needing new reinvestment. And that's basically the point. It's like that they were neglecting their duty to reinvest into the capital base. And then as a result, their competitive position had started to be threatened a little bit more, which had led to slower growth. Granted, they've still managed to keep that single digit growth basically chugging along, minus the dip in 2020. But obviously there's many other companies involved that have been growing alongside them, not to mention all the weird drama that they've had with licensing with Nike and other such things. Questions about whether or not those relationships will last in the future. But anyway, so you can kind of see exactly where the money came into the capital base. We'll actually kind of skip right past the assets part, not necessarily too much to talk about that. We're actually going to talk more about the liabilities. But here it is. In 2018, you can see the long-term debt kind of showing up on the capital base in 2019. I know I said it has more to do with events that happened in 2018, 2017, which is true. But yeah, you can see the huge amount of debt. Their overall liabilities at the start of 2012 was 990 million. Up through 2017, 2018, it was 1.3 billion. And then it jumps to over 4 billion, now close to 5 billion in total liabilities. While yes, their assets did increase pretty significantly following that as well, but not as much. So the overall capital base has shifted pretty significantly. Coming down to the actual sales capital ratio, we can see that through 2018, they had an average sales capital ratio of 4.21. So a really, really strong sales capital ratio. That means for every dollar invested in the business, they were generating $4.21 out of that dollar of capital before adjusting for whatever the operating costs were as well. And then since that has dropped in the last 3 years, it's now averaging $1.65 for each dollar invested in the business. So huge amount of capital injected into the business without any subsequent growth in revenues to counteract that. So that's basically what I'm talking about. Pretty significant change in the overall capital base, and they didn't really get too much for it. So as a result, the stock has been, kind of lagging around, not necessarily going where you would want it to. Obviously, let's see, as far as the year-end prices go, it peaked in 2016, and obviously there's inter-year prices that would be a little bit different than that, but these are the prices listed at the end of the year. $70.97 in 2016. It was still higher in 2017, 2018, and then had significant drop down below 40, and then here we are at $25 now. Obviously, only at the end of last year it was at $43, but still $43 way lower than $70 or $71. So, yeah. Anyway, so with that, we can kind of take a look at the projections for the future. We'll start with the sales to capital ratio. What with the fact that the sales to capital ratio is at a lower point right now, and they're in such a steady state of business, I don't really see how they're going to dramatically change this over time. The only way they could change their sales to capital ratio is by paying down that debt. Like, they're not really going to double their revenues over a really, really short period of time to make their sales to capital ratio jump back up to 3 or something. So I'm going to allow it to drift upward on an expected basis to 1.62 with a kind of a lower bound of 0.75 and a higher bound of 3, kind of leaning towards 1.75. So it's going to drift up to from where the current 3-year average is, but I don't really see it as shifting upward too dramatically. And then as far as the debt to equity ratio goes, they're currently at 135, 136%. So I'm seeing an upward bound of maybe 250% with a lower bound of 75%, kind of leaning towards 150. That gets me an expected value of 154%. That assumes either A, they take on more debt, or their market cap moves downward over time a little bit. I tend to lean more towards the pessimistic outcome of those things, but that is a huge portion of where their value goes, is shifting the debt to equity ratio, because the debt to equity ratio increases the discount rate, not to mention the default risk. Like, that was just a shift based off the discount rate, but then I would also have to adjust for the default risk based off of that, but I'm actually not going to put it back. But anyway, so that's really where a large amount of the valuation actually goes. There is a lot of value in this stock, but a decent amount of it disappears due to the high debt to equity ratio and the default risk that we get as a result of that. So with that, my projections for the revenues, I am using the 5-year average of their historic numbers as my baseline, and then having that trail to a worst case scenario of -5% from there or positive 6% from there, leaning towards 2%. What that gets me is a expected decline in the next year of about 9%. So like I said, they are seeing -4 to 6%. I'm saying about 9%. With most of my evaluations, I've generally been on the pessimistic side as far as near-term revenues, because I do, I guess you could say I'm pretty heavily into the recessionary kind of belief about current economic climate. But anyway, but from there, like I said, I do expect it to kind of trail upward, and then that actually gets us to an expected revenue CAGR of a little under -1% per year over the next 5 years. So I do think it'll grow the revenues back upward, but I don't think it'll reach record revenues higher than 2021 effectively. It'll reach higher revenues than basically every other year that they've had except for 2021 by that point. Yeah, put in that margin of safety for sure. Yeah, that's just how I like to operate. I'd much rather find something that's extremely undervalued and be surprised at the upside. And as we've kind of talked about on a few of the other streams and in the Discord, that there's been some revisions in some numbers, but not nearly enough revisions in numbers. So people are missing a lot of the potential negatives. But anyway, so we'll get into further that. Man, building the whole thing on there. I will say that with that, I did have the probabilities tilted towards the more optimistic model, or our optimistic model being 30% potential chance that they do reach record revenues of 9.4 billion. So I do have it, I have the overall projections pretty negative, but then I tilt a little bit more towards the optimistic end of that, which is, the more neutral end, actually. So that is kind of what I am doing a little bit to counteract that, is that we have more negatives baked in, but we are still trying to lean more towards like a pretty generic kind of outcome. So with that, we have also the margin assumptions. I'm using the 5-year average also as the base here, so we're not assuming that they're going to achieve 9 to 10% in the next year. They're going to achieve something more like 6% in the next year, and then I'm going to have that drift towards a worst case scenario of 1% to 8%, leaning towards 5, and then that gets me basically about a 5% expected margin. That's, you can take the average of their margin over the period prior to COVID, and they had 6.59%. But I'm pretty pessimistic about their margins because of their huge debt costs. And like I said, I don't really see an avenue for them to use that debt to necessarily achieve something super major. And then, as I was talking about with the changeover in their lease terms, they very well might have to accept even higher debt costs in the future, or accept even higher capital expenditures, either way. And so I'm just going to project lower margins as a result. On an expected basis, I have 5% here. It's like that's the part where maybe I'm being too pessimistic, and that definitely would have an effect on their value, because again, that also leads into the default risks, which I definitely have some significant default risks that I've baked into here. So depending on how you kind of play with the numbers, it can definitely shift the value upward pretty significantly by small changes in the margin. But this is kind of where I'm seeing the margins is 5%. I think the 2020 through 2017 kind of time frame is pretty indicative of what their margins are likely to be, even though, yeah, 2020 is a little bit of a outlier year or two. But either way, 5.5%, I could see it getting smaller down to possibly 5%. That does eventually make them project to returns on invested capital of just over 8%. That's compared to, again, the relatively low 11% they've had over the last 3 years, but they did have single digits out of 2 out of 3 of those years. So the idea that they're going to go back to single digits, I don't think is absurd. And then that compares to their cost of capital, which is 8.88%. So essentially, I'm projecting that they're not going to make returns that are higher than their cost of capital. They're actually going to drift to lower than their cost of capital over time, which, by the way, is what companies are supposed to do over the course of their entire life cycle. It's like if you're a successful company, you're higher than your cost of capital until competition comes in and slowly dwindles your returns that are higher than your cost of capital down until eventually they're lower than your cost of capital as competition comes into space. So that just makes sense to me. But as a result of that, that means that their interest coverage ratios are really, really low, and that's how I calculate default risk. So as a result, I end up with pretty significant default risks because of the projected levels of debt that I could see them having depending on these scenarios. And so I see almost 3% chance of default on an expected basis per year across all of these outcomes. And that's really what destroys the value here. Like that's such a huge effect on the value that it's pretty insane. I mean, if I just take away all of the default risk, I mean, it brings the fair value up to $33 per share just by putting all that back on there. So, you know, pretty significant amount of change, which, you know, maybe that you don't think that was a crazy amount, but that kind of doubled the fair value upside just for the default risk. And of course, the default risk isn't there independently. That's the other thing I was trying to say before. It's like the default risk itself is affected by the debt to equity ratio, which is affected by the net margins. So really, it's like all those things would shift together. It's like if we saw a scenario where they ended up not really having major default risk, it would be like shifting this upward while also shifting the debt to equity ratio downward, while also shifting the default risk downward. You know, like it would be everything all at once being together. Those three things are all tied together, and how that would change the value is pretty dramatic. Yeah, up to $41-42 per share just by effectively saying that they don't default, and that they have zero chance of defaulting over the next 5 years. Like, it's not that they don't have defaulting, it's that the market would also perceive that there is zero chance of defaulting too. That's the other fact that's kind of tricky about this. So anyway, that's just the kind of the point of saying it's like really a large factor that makes them a value play is the default risk. They're as cheap as they are because they have a significant amount of debt. They don't have a lot of growth avenues for that debt, and the chances of getting out from under it is, you know, they have potential to do it, but it means that they have to essentially be razor focused on that, and basically that alone. I'm not necessarily sure that that's their approach. So anyway, that basically gets us all of the assumptions for the final valuation, though. As a result, yeah, I'll give it a pass. Yeah, basically, like I said, I had said it at the end of last stream when I said that this was the one I was going to do. I was mostly kind of doing this one more to just compare it with Hibbett, my own holding, to kind of get a feel a little bit more for the space. I like to do other companies in the same industry as my other holdings and stuff to kind of get a more holistic view. But yeah, it was I kind of knew it wasn't going to be super interesting for me from the get-go. And that's the thing. It's like, you know, if this was like, look at this, the discount rate's high, right? The discount rate is very, very high because of the default risk. And so that's where those returns are baked. It's basically saying that, yeah, you could get very high returns with this stock, but those returns come as a result of the default risk, as the default risk increases the beta, which increases the discount rate, which lowers the present value. You know, so it's like it's all one equation that all bakes in together. It's like this number is so high because this number is so high, but that's also why this number is relatively low compared to this number. So yeah, there's a lot of returns here, but a lot of risk to achieve those returns, effectively speaking. So if you're still watching this point and you haven't already liked the stream, please like the stream. It'd be very much appreciated, or subscribe if you're not already. This is pretty much the final valuation. Ticker FL, Foot Locker, U.S. Treasury, 10-year Treasury selling for 3% or so. The mature market equity risk premium that I currently have is 5.7%, and the discount rate I'm using is 16.71%, and their current dividend is 4.72%. What's the bottom of the pricing? Yeah, ignore this. I will say. This is a tool that I find useful for some companies, but it's easy to find not useful depending if you know what's going on here. Basically, it takes a correlation of the pricing metrics of PE, price to book, price to sales, EV into capital, and EV to EBITDA for the S&P 500, and kind of bakes out the fundamentals of it to figure out what a PE should be based off of a company's fundamentals. So for a PE ratio, I plug in the beta as my proxy of risk, as well as margins and payout ratio, because those are the three factors that are like most statistically significant to a PE ratio. And you bake out to find out what would be the PE ratio of this company based off of the metrics that you put in. And so it says that Foot Locker, under those circumstances, based off of a correlation of the S&P 500, should be trading at a PE of 25. But that doesn't take into account the debt. It doesn't take into account the default risk. So it's easy to explain away for a lot of companies, but it's something I like to use as kind of like an icing on the cake for certain companies. It's I basically ignore it for most cases. It's like I said, it's not actually as useful because there's some it's a correlation metric that really only works if you redo the correlation and the regression against the S&P 500 relatively regularly. And so I haven't actually redone that regression for the last like 6 months, and the market's changed a lot in the last 6 months. So it's mostly kind of irrelevant. But I digress. I ought to really just kind of delete it, but you know, it's just one of these things that end up doing so many other things. But yeah, mostly just ignore that. Just focus on this. This is what's important really here. Anyway, the sales 5 years ago, $7.7 billion in sales, and the most recent year it was $8.9 billion. That equates to sales growth of 2.9% on a compounded basis. The sales capital ratio for the last 3 years on average has been 1.65, which is relatively low compared to their industrial grouping of 2.34. Their returns invested capital for the last 3 years on average has been about 11%, and that comes off of the back of their current debt to equity ratio of 135%. The default risk that they have in the most recent year, I didn't actually adjust for the most recent year, but it's not really all that relevant necessarily. Well, actually, in the most recent year, they didn't have a major amount of default risk, but that comes as a result of the fact that they had a relatively high profit margin this year. So, well, that is what it is, but that's not really relevant. This is the part of the default risk that's actually relevant. This is just the past. Profit margins for the last 3 years on average has been 6.17%. Against their industrial grouping currently of 5.74%, and they currently have a profit of $893 million and are selling for $25.45. The probability distribution that we're using for our future projections is pretty heavily tilted towards our more optimistic fourth model. As I was explaining before, that kind of comes off of the back of sandbagging the numbers into some pretty conservative estimates for the revenue. So really it's kind of leaning more towards a pretty default steady state estimate. I mean, like I said, on an expected basis, the revenue we're assuming that it stays basically flat over the next 5 years. It's slightly downward actually, but mostly flat. And either way, the worst case scenario that comes to about $6.2 billion in sales, up to a best case scenario of $10.7 billion. On expected basis, we see about 8.5 to 8.6 billion. Again, that's against negative 7% in the worst case scenario to 3.75% compounded per year in the best case scenario, about negative 1% or so in the expected case. Sales capital ratio on an expected basis, we see 1.62. That's $1.62 in revenue for each dollar of capital invested in the business. And that gets them returns on invested capital of just over 8%, which, as I was saying, unfortunately means that the returns on invested capital would have drifted below their cost of capital. But that is that's life for a business. That is moving from middle age into the golden years as far as a corporate life cycle goes. So that's just the way that moves. Debt to equity ratio, we have an expected basis of about 154%. This is, as I said, the part where maybe I'm being a little pessimistic. I tend to try to always be a little bit conservative as far as where the debt to equity ratio would go. Milking a dying cow. Yeah, that's part of how it works. It's like companies are competitive. And when they're competitive, they have high returns on invested capital, well above their cost of capital. And that's what we call excess returns. And then eventually those excess returns go to zero. In fact, eventually they typically go to negative numbers until eventually the company is liquidated. And that sign that the excess return has gone to negative numbers is the sign to liquidate the company. That's exactly what that sign is. So what you could argue is that the returns on invested capital are currently above their cost of capital. And so you could argue that this 5 years is the last 5 years of good value to get out of Foot Locker, maybe. And then after that point, it would just basically be a book value type valuation play, perhaps, depending on where the pricing action goes, of course. Because if the market decides to price in this to a higher level and drop the price down to 20 or something, well, then it extends those returns further out. So it really the effect of how quality your returns are depends on those things, on where the market puts these things. But as far as on an operating basis, yeah, it's milking a dying cow. Returns on invested capital is one of the key things. That's why people like to pay attention to that metric so much, is because it tells you about the operation of the business, not necessarily about the returns that the investor's getting. But usually they tend to equate pretty well over a very long time. So that's just kind of how it works. Anyway, as I was saying, with the high debt to equity ratio that I'm projecting of about 154%, I come to a default risk on an expected basis of 2.93%, which is pretty damn significant. Like I said, that's per year, and it compounds. So almost 3% for 5 years. Like I said, after the compounding, maybe it would equal about 15% exactly, or something in that range. So a 15% chance that this company goes bankrupt in the next 5 years is basically what that means, approximately in that range. Not crazy chance, right? It's like, that's not an insane amount of chance, but not a comfortable amount of chance, is my point. So yeah, profit margins, we have a range of 1% to 8%, leaning towards 5. That gets us just over 5% as our profit margin. We see a profit of about $431 million in the 5-year forward period. That gets us our present value using the discount rates that we're using, up to $28.84, which is 13% higher than the current share price. 5-year forward value targets unadjusted for the dividends that they will pay out during the period, of a worst case scenario $14.61 to a best case scenario $143.71. That must be the circumstance under which it reaches that PE of 25, I guess. But yeah, on an expected basis, we see $62.41, and comparing that to the current share price, with the discount rate that we're using, that gets us an implied return each year for the next 5 years of 19.63%. So yeah, some pretty fat return potential here, but it comes off of the back of a potential like a 15% chance of default. So yeah, that's the valuation. Like I said, it's in absolute terms, it's basically about the same present value that I have in my previous year valuation, even though the revenues have increased pretty significantly, and my projected revenues have increased significantly, and my projected profit margin has increased a little bit as well. So it just goes to show just how big of an effect that discount rate can have. And like I said, everybody's cost of capital has been going up. So if your cost of capital was already high, your cost of capital probably went up even more. And that was just kind of the case with this one. So that's basically going to do it for the valuation today. As I said earlier at the start of the stream, I'm almost certainly going to be doing Inter 4 next, and then perhaps Graph Tech next after that, looking at other options for what will be coming thereafter on all that. Appreciate everybody joining the chat. And one last time, if you haven't already, I see we got 2 likes out of it, out of 3 concurrent currently. If you haven't already watched it, or if you're just watching it on the replay, please like the stream. It'd be very much appreciated. Catch you next time, Nick. Thanks for participating. I'll catch you all again next time.